चैट साइड में लो थोड़ा सा. हाँ, you are
Close.
you are live now. I'll check. Wait 1 second. Right, 20-30 seconds का delay रहता है. Yeah, you are live.
Is it okay?
मैं क्यों दिख रहा हूँ? सिर्फ अपने पास ये वाले का बस. हाँ, बुक वाला एकदम ठीक है. पूरा स्लाइड शो मत करना. मेरा फिर इसको देखने में कि वीडियो कैप्चर ही. हाँ ना.
अभी भी 2 ही पार्टिसिपेंट्स दिखा रहा है.
क्या है उसका क्वेश्चन? We'll start just a couple of minutes before we get this. Is it okay? That's okay, don't worry about it. Let's just get started.
Yeah, also.
That's it. But doesn't seem to be okay.
Camera is working.
ठीक है, we can just delete this thing. हटा दो उसको. No need, we can just remove this thing. This entire thing can go on.
Okay, I'll just go with the video. See, same.
मगर इसमें क्षितिज
हाँ,
इसमें नहीं है.
delay रहता है, so 20 seconds.
Okay.
Yeah, you are.
Hi everyone, sorry for the delay. Thanks a lot for joining. We will now start with basically the idea was to sort of do a live session on YouTube to capture what we are thinking in terms of how the markets are currently, the impact of Trump tariffs, how the quarterly one results have been, right? So idea was to cover some of these things, and of course if there are any questions, this is supposed to be an ask me anything type of session where we'll take up questions. Disclaimer here to begin with that these names that we take on this call, stock names that we take on this call, are not buy or sell recommendations. This is just purely for discussion purpose, and people who are not our clients, please take advice from an advisor, sorry, before you take these calls, right? We will not be responsible for any profits or losses arising out of these, trades. So, with that, let's just get into the presentation. I have a quick 4 or 5 slider, uh, probably some few more slides, basically to present what we believe. So quickly, we'll take up our, our performance, small case performance. Uh,
Not showing.
Sorry.
Yeah, not showing.
So quickly, what we'll do is we'll talk about our performance. So our Technofunda portfolio is now almost 3 years old. We've done almost 37% CAGR here. Our venture capital investors portfolio is about 35% in terms of the 3-year return. You can see the alpha that we've done basis the index, and this is our small case. So you can basically visit wealthculture.smallcase.com to check out our existing portfolios that we have. We only do only 2 schemes. So all the effort that we put in terms of our research goes into just these 2 schemes, right? Now, getting into some of the serious economic stuff. So what we'll try and do is basically cover 4 or 5 big issues that we are seeing right now. So the first problem with the current state of economy as it is today is the slowdown in bank credit growth, right? As you can see, that the bank credit growth in as per the June data has come to 5.5%, which was much higher in, let's say, 2023, right? And from 2023 we started seeing the credit growth go down, and this is banking credit growth, right? So a lot of basically our economic GDP growth depends upon how fastly or how easily banks are giving out loans to individuals, corporates, businesses, MSMEs, microfinance loans, all types of loans put together, right? And that credit growth has basically slowed down to as low as 5.5% as per the most recent data, right? Now, this exactly is one of the biggest challenges that we are seeing right now. Uh, we've had a couple of big issues. For example, personal loans had gone up significantly towards the end of FY24 and continue to be high even in FY25. There was simultaneously there was a microfinance issue where a lot of NPAs started coming in the microfinance sector, and you must have seen a lot of microfinance stocks have taken a beating because of that, right? So these are some of the 2 big issues. The third issue which we will get into is again on the corporate side, because corporates are not doing any capex. So, and whatever capex is happening through internal accruals as against taking loans from banks, right? So for those reasons, bank credit growth is very low right now. Unless this figure starts to go up, as in it starts to inch up towards 10%, 12%, 15%, we will not see real recovery in terms of our economic growth, right? So the GDP, as it stands today, is has significantly reduced from the 2023 peaks. 2024 was a dull year. 2025 is definitely a dull year, and we are seeing that pressure now starting to kick in. So which is why RBI had to go and reduce the lending rate significantly, and they have done from a monetary point of view. RBI has done enough to basically encourage more credit growth in the economy and in the system. There might be some more fiscal measures that the government can take, keeping in mind that we have a fiscal deficit to meet. But what the government can do is basically essentially, I think there's something happening on the GST side where the government is trying to cut GST rates to in order to increase spending and consumption and essentially lead to more credit growth. which could be supported by, let's say, some of those asset, uh, by government selling some of the stake in large government enterprises, right? So through those measures, the government could meet a certain, fiscal deficit target, while making sure that they are doing enough to, from a physical standpoint, they are doing enough to basically encourage growth and consumption and bank credit and all of that, right? So that's essentially one of the biggest problems as of today. Now, the second issue that we are seeing, as I mentioned, you've seen that microfinance loans have gone down. Personal leverage is already quite high. So, again, the retail book is also very slow in terms of growth. The third biggest factor, again, is corporate capex, and corporate capex is not happening. As you see on the right side, the debt growth of the 343 companies in BSE 500, the CAGR for the debt is only 5.57, whereas cash on the books of these companies has grown at a 10.43% CAGR. So what's definitely happening is that a lot of these companies are not incurring capex as we stand today. That could be because of various geopolitical issues, could be because companies didn't have a lot of clarity on US, what Trump would do in terms of trade tariffs, and just the overall economic situation right now is not that, not that encouraging in terms of private capex. And the government has been trying to push for private companies to do more and more capex, but sadly that has not come through. Even though the government has been doing its own public spending, in terms of infrastructure spending, in terms of railways, in terms of power sector, in terms of water, Jal Jeevan Mission, and all of those things, the government has been forthright in doing a lot of that spending, which again is showing up in the PSU stocks as well, and defense stocks as well. But private sector capex has been very slow, and whatever private sector capex has happened, it has been mostly done through internal accruals as against taking credit from banks, right? And for that reason, there's nothing much happening from a private capex point of view as well. So from a overall economic perspective, there's not a lot of credit growth as you would see, because all the 3-4 major segments are quite dull right now. And this is again a cyclical phenomena. It's not like, it's after 3-4 years of amazing growth post COVID. The base is quite high. People have over leveraged themselves. Both the microfinance sector and the personal sector has over leveraged, while the while companies still waiting for more clarity before they start doing capex. And in due course it will come. The private capex will start kicking in. We just don't know when, but in some time it will start kicking in. Now, so these were basically, from a credit growth point of view, couple of pointers. The other thing is that in terms of earnings growth, what we've seen in Q4 FY25, and the first quarter of FY26, the earnings growth is not more than single digits, and it's been like this for the last 4 quarters, and that itself is a huge problem. Right? And couple of reasons for this. First of all, overall GDP has gone down. There is, of course, we are looking to grow on a high base, after 3-4 years of amazing growth post COVID. So the base is quite high. It is difficult to deliver a 12-13% nominal GDP, and even from earnings point of view, it is now getting difficult to deliver a double-digit earnings growth. So we've been at single digit for the last 4 quarters. I think by end of this year or early next year, we should start to sort of improve and get into early double digits from an earnings growth point of view. Also, if you look at the consumption environment right now, plus the export environment, is not that great. Geopolitical tensions, a lot of trade conflicts have sort of led to this scenario that we are right now. And as you know, private capex has taken a backseat. So for all of these reasons, the net effect is that the earnings growth is not is single digit for the last 4 quarters. and that is again one of the reasons why you're not seeing money flow into the economy, right? So the fourth factor, which is the liquidity factor, liquidity is not coming into our economy. We've seen this since September, October last year. September all the way till March, we had FIs exiting, and then for about 3-4 months, March, April, May, June, we had slightly positive FI inflow, which again in July has completely been sort of normalized, as in the net effect, if from a March to July point of view, is again we are looking at a negative FI number. So from a flows point of view, starting September last year till June, July this year, we've seen overall we've seen FIs exiting our country. And to think of it, of course, the couple of reasons: economy not doing well, GDP going down, earnings growth not as good enough, and valuations being high, right? So as we speak right now, I'll just cover the valuation slide first. Valuations are not that high, but they've come up from the peak. But to say that Nifty 50 is at 21, 22 times price to earnings even today is again slightly on the expensive side. Nifty 500 overall valuation currently stands at 24 times price to earnings, which again is not at all time high, but again it's relatively high. If you look at the 10-year average or the 15-year average or the 20-year average, you will see that these valuations are relatively high, especially in the context that we've been delivering single digit earnings growth for the last 4 quarters. Right? From that point of view, these valuations look expensive. If we had been doing double digit growth, then I don't think FIs would have stayed out. It is precisely because of these 3-4 reasons: credit growth, GDP sort of normalizing to less than, I think we're looking at 6.5%, somewhere in that range GDP growth, which is not a bad number, but it's a cyclical downturn that we are going through. Uh, Earnings growth are not coming through, and because of all of these factors, FIs are not taking interest in India right now. This problem can sort of remain for some time until we get to I think by the end of this year, our assessment is by the end of the year, somewhere September, October, we should start to see some improvement in credit growth, followed by some improvement in earnings growth, and then some sort of new money, new FI money flowing into Indian equities at somewhere that point of time. So, what's the silver lining? All that we've discussed is of course negative stuff. What we are, and let me quickly cover Trump tariffs also, because again, new thing that has hit us. An additional negative, I would say, we were expecting something like a less than 20% number, maybe 15, 20, sort of, that was the expectation, but 25 was definitely not expected. Now that we are at 25 plus some penalties, for especially for doing business with Russia, uh, I think a couple of things here. So we don't do more than 2.3%, 2.3% of our exports only to US. So from a numbers point of view, it is a small number. The net impact on the GDP from a numbers point of view is estimated to be somewhere in the 0.2% of the GDP range, zero point 0.2. So at max 6.5 can come down to 6.3, 6.2. That could be the max hit in terms of GDP numbers. But of course, emotionally, the market has reacted a lot. I think the reaction is somewhat overrated. Uh, we believe that you know our negotiators, from the Indian side, will eventually get this down to somewhere close to 20 or 18, 19, sort of number. We are currently certainly disadvantaged as of today. So a lot of sectors, for example, smartphones, textiles, apparels, jewelry, some chemicals as well, auto parts definitely, agricultural, seafood, especially seafood, a lot of shrimps exported from India to US. And so a lot of these sectors will uh, see some negative because of the Trump tariffs. Pharma, but some will remain resilient, because from a pharma point of view, I don't think we are already at quite low margins when it comes to pharma, and I think anything will get passed on to the US consumer. And I don't think US is in a position to manufacture generic drugs on its own, because it's almost 8x expensive to manufacture the generic drugs in US versus India, right? So that's manufacturing in US is definitely not happening. What can definitely happen is Indians will definitely end up passing the extra cost to the US consumer, and eventually we believe that the rates will come down. So from a numbers point of view, it's not that big a deal. Maybe a short-term impact, 1 2 quarters. From a third, fourth quarter, will again come back to normal. That's what at least the understanding is. While the emotional sort of response to this has been quite exaggerated, we believe. I don't think the way the markets reacted, for the last 2 days, we need markets will probably reverse. The reaction was definitely overrated. So, so the way we are looking at it right now, I mean, it's a perfect storm. We are currently, we've seen a 3 4 year growth phase after COVID. Our markets did well. We made a lot of money in small and mid caps. Last year we switched to large caps as well as gold, silver, because we saw this problem coming. So for the last 1 year, we've been relatively doing well, as against people who've been accumulating small and mid caps all the way through. I think they've seen a larger drawdown in their portfolios. Our clients and our small case, we've been relatively doing well even in the last 1 year. Of course, returns have normalized, but relatively we've been doing well because we've sort of protected our portfolio by having some of these defensive bets, right? But I think where we are right now, uh, we are seeing a phase where, in terms of credit growth, I think 5.5% credit growth is already sort of very close to the bottom. We've already seen rate cuts from RBI that should help in terms of passing in terms of encouraging banks and financial institutions to lend more actively and take higher risk. So we should see that credit growth start growing from here onwards. It might take maybe 1 2 quarters more, but it should start, and that should again lead to higher earnings growth. And as we see higher earnings growth, I think there's no other place globally which is growing as fast as India, and valuations being what they are right now, I think we will eventually start seeing more and more FII flows, FPI flows into India, right? So it's just a matter of timing, maybe another 5 6 months or so. So from that point of view, plus these new Trump tariffs which have added to the negativity, it sort of feels like that we are at this point of time in the worst of times. If you look at the last 5 year history, this might just be the worst time in the last 5 years. And that also means that we will start to we'll start to see some reversal from here onwards, right? In terms of inflows, in terms of credit growth, in terms of earnings growth, all of these factors uh, will not get. I should say we are close to the bottom. I can't say it will not go worse, but probably we're just very close to the bottom here. So the good thing is, in terms of Trump tariffs, we've already been hit by 25%, and my understanding is that the bottom is 15 and the peak is 25. So 15 to 25 is the range for which US is putting on all the other economies. We are on the higher side, so obviously we've been hit by the worst number, which is 25%. I think over a period of time, whenever our Indian negotiators can negotiate a slightly lower number, there is a potential for some basically upside from that. If we eventually, let's say, come down to 20 from 25, that will be a positive trigger. So from a Trump tariff point of view, of course, the worst is discounted. From a credit growth point of view, some experts have said uh, that it can get to 9.5%. It's likely to pick up by the end of this year. We expecting credit growth to start going up. some macro experts have tried to sort of predict that reversal, and eventually what we've seen, FII FPIs, of course, flows have been very. I mean, we've seen net outflows, but there are some sectors like banking and telecom which are seeing inflows even as we speak today. So it's not like FIIs are exiting India from each and every sector out there. There are they have they are sort of putting in money where traditionally we've seen non-performance. For example, banking and telecom, these are two sectors which have not done even in the last 4 or 5 years, while the overall economy has done well, but banking and telecom have remained sort of underperformers, and the valuations still remain quite attractive in the space, which is why we've seen more and more FEI flows going into banking and telecom, even as the on a broader level we've seen outflows from India. So it's not completely negative, and I think over a period of time we will see a lot of new money coming in as well. So I'm not aware of this additional 10% tariff. I think the net tariff on India is 25% only. It's not 25 plus 10%. That would just be devastating. I think there are some penalties, but again, we don't have clarity on penalties. And the understanding is that eventually these penalties will go away, and from a tariff point of view, we will come down from 25% to 20%. Now, let's look at what are the sectors which are looking good, right? Because one thing that and I think a lot of people have said this on news channels also, and even we agree with that statement, that the broader indices will not move significantly. So Nifty 50 and Nifty 500, which are the two broader indices, will probably stay range bound, and that's because some sectors will do well, some sectors will not do well. So it will be a mixed bag, and because of that mixed bag, the overall index will sort of remain range bound. Now it is for us as investors to figure out which are these sectors which will do well, which will not do well, and hence stay away from the ones that will cause more trouble going forward. So let's talk about what can do well. I think we've seen, and we've been invested in the banking space for now more than a year. Large cap private banks we started buying around the same time last year. So we've been invested in this space for some time now. Um, Quite a few. I mean, our investors would have seen some of these stocks do well in their own portfolios, and so. But we've taken more positions here. I think with the microfinance sort of bit already playing out and getting discounted, there are quite a few microfinance bets which are again starting to look attractive, right? So we're starting to uh, so I think from our point of view, we are heavily invested in banking right now. There are there are at least 5 6 positions where we are invested. So one could say that out of our entire portfolio, I think we are slightly overweight on banking and BFC, and that includes home finance. That includes some of these microfinance bets as well. So I think tactically it makes sense to be slightly overweight on banking and finance right now as we speak, and we're also seeing good FII inflows into that space. The second basket is, of course, chemical. Chemical has not done again after the September 2021 peak. We've not seen chemicals do well. A lot of hue and cry around China one, but when we went into the value chain to understand which are those chemicals which are actually benefiting, because what's happening is that of course US is putting a lot of trade barriers on China, and hence China is starting to dump a lot of their chemicals on countries like us, Brazil, Latin America, because of which that is starting to affect us negatively, right? So our domestic chemical companies, leave alone China plus one, we're actually getting hit by China directly because of this dumping, right? So very selectively, we are looking at value chains where we don't have dependency on China, where there is a real China plus one story, and those are the very specific handful of bets that we are taking there. Again, gold, silver, we've been invested for around the same time as we started buying gold, silver last year. I think we are comfortably 30% plus in gold silver right now. We are holding this position because, again, from a US inflation point of view, we believe that inflation will keep going up, and at some point of time, Fed has to do rate cuts. Uh, that will be a tricky situation for them, but we believe inflation will keep going up, because of which we continue to hold our gold and silver. Incrementally, we are not buying more because we don't see so much upside from those current levels. But from what we've been buying in the past, I think we'll continue to hold. Maybe there's another 15-20% potential here. Again, nothing is a buy sell recommendation, so please don't take this as advice. It's just our view that gold and silver will continue to remain strong, even going forward towards the end of this year. I think towards the end of this year is when we'll probably see it peaking. So 5-6 months for sure we are holding. Hospitals is another sector. I think this sector has seen a lot of capex in the last 4 or 5 years, which is now starting to materialize in terms of utilization. All the way from Max, Apollo, Narayana, Kims, all of them are doing well. Again, not a buy sell recommendation, but this space again has seen a lot of inflows. The fourth space, which uh, is getting a lot of attention, and for the right reasons. Power, of course, there's a national electricity plan by the government of India, which, as part of which, there's a huge capex outline to be spent in upgrading our power infrastructure, plus, of course, expanding the grid capacity in order to basically, encompass all the new, solar as and wind capacity that we are setting up across the country, right? So from a, it's one sector which will see a lot of government spending over the next 2-3 years, and for those reasons we are invested. EMS, very interestingly, this is one of the only manufacturing sectors out there. I mean, India tried to do PLI, but out of all the manufacturing sectors, EMS was the only sector which could take advantage of PLI. For the others, it was just a sort of a policy with no real cash, being given out to these companies, whereas EMS actually benefited from the PLI scheme. And we believe that eventually, over a period of time, this sector will see a lot more momentum. There will be serious, uh, what do you call, execution in terms of building supply chain in India. Not just, and as we speak today, we are only probably doing assemblies and very basic PCBs, but next 10 years on, I think in the next 10 years, we will in India end up manufacturing at least 70-80% of all the components that go into mobile phones and all the electronic equipment. I think only some of these very difficult to manufacture chips, right? Which is, of course, the expertise of US and China. I think that will just probably be that 10-20% where we will not be involved. But I think for the others, we are starting to build supply chains in India in a very serious way, and I think this is still a very emerging sector. I think for the next 15-20 years, a lot of room here to keep growing. Uh, and the last bucket is the consumer bucket. Again, this bucket has not done well. We've been invested in some consumer stocks. We've seen some underperformance there, but I think from Q1 we'll see some improvement in Q1, very initial improvement in Q1, and probably Q2, Q3 will be the quarters when consumer will actually start doing well. So there is some time before these companies do well, and these are companies like, again, not buy sell recommendation, but Trent, Bata, anything related to consumer discretionary, your apparel, your shoes, even your, this year summer was quite short, so, but even consumer durables for that matter is a very good sort of segment to invest. But yeah, I think these are the six buckets that are doing well. We are seeing FI inflows there, and as we see in Q1, we are seeing good quarterly performance, good earnings growth in these sectors. Now, where we see there will be some sort of issue are those sectors which have already sort of run up a lot. For example, real estate, hospitality, auto. These sectors have already sort of played out. The valuations here are already quite expensive. The base is quite high. Again, and these are essentially cyclical sectors. All three of them, right? Real estate, hospitality, auto. All three are cyclical sectors. They've already run up for the last 4 or 5 years. We believe that these are peaking right now, and these sectors could start to see their numbers go down. If in FY26, if not in FY25, at least in FY26, I think they'll start to see their numbers go down, valuations will go down, and that is why we believe that it will be a mixed bag. Some sectors will do well, some sectors will not do well. As unlike COVID, where every sector was firing, except for banking and a couple of handful of sectors, every other sector was firing. Whereas now we have a decent number of sectors who already run up, will probably start to see some sort of downtrend, and there are a few sectors now which will from here onwards do well. So which is why we believe a mixed bag, and overall Nifty and Nifty 500 should not move significantly. It should be range bound, and hence it is very important that if you want to beat the markets from here on, you have to sort of be at the right places. You have to be a stock picker as against a ETF or an index investor, right? And that is how I would sort of conclude this session. And happy to take any questions. So there's one question: there are lots of wars in the world currently, and considering the world situation, there could be more wars in the near future. So how are Indian defense stocks projected to do in the near term and long term? So defense is not just it's not a very short term thing. Defense, I think, has a very long term implication, and I'll explain you why. Because the world is becoming more polarized. It's not just US right now, but China has also become very significant now, to the point that, especially with rare earth, China is actually at a better position than US, I would say, right? So we are looking at a bipolar world. Uh, there are proxy wars being fought, and there will be more proxy wars being fought. Uh, in which case, it is important that the defense budget should keep, because imagine India and China sharing border. We already have a lot of border tensions, right? So what if China is increasing its defense budget? There is no way that we can stay quiet. We will also have to increase our defense budget, and this is a 10, 15, 20 year phase, could be, where the US will start to go down as a political power, as a financial power. US will now start to see its sort of overall role in the global economy sort of waning down, and China will probably take center stage. BRICS will probably take center stage, uh, right? So for those reasons, it is not going to be a very smooth ride. There will be proxy wars, and for those reasons, I think defense is one space which, from a long term point of view, sounds very interesting. The other thing is that we as a nation have been defense importers, right? And we're starting to see some silver lining there also, where for the last 5 6 years, if you look at the Indian defense export data, we as a nation have been exporting more and more, and there are some very good companies in India. I mean, I'm not talking about the obvious HALs and BLs of the world, which of course get a lot of their budget from the government itself. But I'm talking about defense companies in India that are manufacturing for the global clientele, right? And those are some of the bets that we really like. We are not, as we speak, we don't have any of these usual suspects like HAL, BL, and all, because this is again very government spending led. We don't want to expose ourselves to a single client. We like to keep ourselves diversified, and from a product point of view, we like to play in segments where we are exporters to the world, and that we believe is a long-term story. It's not a short-term story, not a 1 year, 2 year, 3 year story, but more like a 5, 10, 15 year story, where over a 15-year period, you will see some of these Indian defense companies play a more stronger, more profound role in the global economy. And yeah, so we are invested in some of those bets. Again, I will not be able to take names, but yeah, there is an export angle here. It's not just import substitution. but an export angle here, which I think will be a much higher wealth generator, wealth creator for investors like us. Uh, I am an engineering student currently, fourth year of AI and BTech, and I'm an enthusiast about stocks, forex, finances, and wealth. I found my interest growing in these sectors, and as I would ask, how can I go about it in my future? So look, for somebody who's wanting to get into this space, it's all about passion. There's nothing else. Whatever sort of keeps driving you, just keep doing that. Now your interests will evolve, and there's a lot to do. It's a huge space. You have commodities, you have long term, short term, intraday, swing. There's a whole lot of stuff that you can do. Figure out what you want to do. Figure out what works for you. What behaviorally, what aligns with your behavior. For example, I as a person can never do short term and intra. It's not just my thing. I cannot sort of. I don't behaviorally. I'm not that aligned to play short term, intra, and even futures and options from a trading point of view. Not my cup of tea. So figure out what you can and cannot do. Uh, and yeah, just keep doing that. Thank you for your question, and hope you got the answer. Any other questions, or we'll just end this session? Uh, please share your views on hospital, hotel, capital goods sector. So look, hospitals, a lot of capex has gone into that sector in the last 4 or 5 years. Uh, we've seen a lot of uh, brownfield acquisitions, not so much greenfield. So a lot of big hospitals have acquired smaller, standalone hospitals here and there. They've expanded their presence across India. Narayana, Hrudayalaya, Ames, Max, Fortis. These are well-known brands. They're doing well, and their ROCs till date had been very nominal. Single-digit ROCs. Excuse me, which has now starting to go up because of the utilization. So a lot of these hospitals are now starting, to come into utilization, because of which their ROCs have still got up, their profitability and revenue numbers have increased, and that's precisely the reason why this sector has done very well. So I reckon that this sector will continue to do well, especially think of it this way, because the government has no intention of setting up hospitals. Government is not getting into the business of setting up hospitals. It is the private sector that has to take charge of that, uh, and for that reason, private hospitals will keep growing. That sector will grow uh, at a good pace in India for the next 10, 15, 20 years. I think there's a lot of penetration that we've to reach to. But the only thing is that you have to look for these capex cycles, because you've just been through a capex cycle, and now we're starting to see the fruits of that. So I think in terms of stock movement, we will surely see stock movements sort of slightly picking up over the next 1 to 3 years, till we reach a valuation which then becomes expensive, and then we'll see a fresh wave of new capex. So again, cyclical sector. I think good times right now. I think there's more to go in terms of hospitals. Hospitality, we've already seen. We've already seen rentals, room rents doubling in the last 3 4 years. There is a lot of capacity that is in the pipeline, which will come in 26, 27, and at that point of time, uh, because coming out of COVID, we also see a lot of people wanting to travel. So that was obviously one of the reasons why that sector did well. Prices went up. There was shortage, more demand, less supply. But as supply, kicks in FY26 and FY27, I think we'll see valuations and stocks sort of, doing not so well over the next 2, 3, 4, 5 years. I think we are somewhere close to the peak, in my opinion. Maybe at max another 2 quarters, and then next year, say, we should start to see some rationalization. Again, not a buy sell call, just from a cycles point of view, I think we are at the peak. capital goods sector, engineering, and all of these sectors will do well. I think, especially sectors that are related to local spending, for example, Jal Jeevan Mission, and that led to a huge sort of capacity expansion in the pipe sector. Everything water related did very well for the last 4 or 5 years. In fact, a lot of pipe companies were exporting to global Middle East and other countries as well. So that sector continues to do well. Manufacturing, I think anything which is domestically sort of driven will do well. We A lot of capital goods get exported to US also. So I think as and when the tariffs come down, I think we'll see some improvement there also. Auto parts again, huge exposure to US. When the tariffs come down, maybe we'll start to see some improvement there. But I think broadly capital goods, anything related to sort of pipes um, or stuff like that should do well. Infrastructure related stocks, cements, and local domestic infra related stocks should do well. Typically these companies grow at 10-12% CAGR over the long term, right? So I think cement is already starting to do well, which will be followed by some, for example, tiles, ceramics, stuff like that. That segment also should do well. Energy again remains a very long term theme. We've been invested in energy and we'll continue to buy more in that segment. I think, especially given the national electricity plan and the renewable energy targets for FY 2030, I think for the next 4 or 5 years, this sector has a huge growth potential. Uh, but even if you think of the overall energy distribution in India, a significant part of the energy is still derived from thermal energy. So we have a long way to go in terms of solar, wind, and battery storage systems. Another business model which is again start to pick up. I think all the companies which do a combination of these three, which is solar, wind, and battery, should continue to grow well for the next 5, 6, 10 years. Huge potential there. Industrial sector, I think, depends industry to industry. Again, depending upon which sector and what cycle, I think you can take those bets. But our overall economy grows. Anything domestically will do well. Anything where we have especially sectors where we have some sort of global dominance, where we don't depend on external value chains. Those sectors will continue to do well. I think auto will definitely do well. It's just that auto itself is a cyclical sector. Has been doing well for the last 4 or 5 years. If you see some of the auto ancillary companies, they've done tremendously well. And uh, uh, so again, there will be some sort of consolidation there before we grow to the next phase. But generally, these sectors do well. Be very careful about capital goods and industrials. Be very careful about the valuation. Look at the cycle. Look at the valuation. Try to get closer to the bottom. Try to sell at the peak. It's better to play that story through sectoral rotation, rather than sort of being invested in something like this for 15, 20 years. I mean, generally speaking, try to play the cycles. uh, and in something like an energy or a recycling, where you have a 15, 20 year story, there you may not play the cycles. There you can just buy and hold, and because the growth ranges from 25%, 30% to 15%. So even in the worst of cycles, they are growing at 15%. In the best of cycles, they're growing at 25%. So 15% growth is not a bad growth. So for that reason, stay invested. But in sectors where in the worst of cycles your growth rate comes down to 6, 7%, 7, 8%, that is what you want to avoid. Small finance banks and NBFCs, like I said, I mean, we are very bullish on that space. The entire wealth management space plus banking space, credit growth, like we discussed, has been very low. So whenever credit growth picks, I think this entire sector will get re-rated. I think the peak of this sector will be when banking credit growth in India will be somewhere close to 15, 16, 17%. As of now, year on year, as of June, the bank credit growth is 5.5%. So we are not lending as much. The book itself is not growing, uh, and because of that, valuations remain very attractive. We have seen a lot of NPAs come out, so it's already discounted in the valuation. And so as we sort of see the credit growth go up, we should see valuations also improve. And I think in the broader finance sector, we have large banks, we have NBFCs, we have small finance banks, we have home finance banks, we have microfinance lending institutions. All of these are sort of, in my view, well placed. uh, Especially in our portfolio, we've taken, I think, one from each of these spaces. So we have a good 5-6 exposure to at least 5-6 stocks. Plus, there are some good turnaround situations also. Would you like to throw some light on the mother industry, automobile and real estate? So auto has already done, in my view, the classic example is Tata Motors. You would have seen the numbers. We've been talking about this for almost 6-7 months now. Uh, so auto has two segments. One is the, of course, high ticket segment where you have EVs being sold and 20-25 lakh cars being sold, which is the typical price point for buying a Tata Motors or a Mahindra and Mahindra. I think that segment has already played out. What is now playing out is your Maruti and two wheeler. So two wheeler and Maruti, cars less than 10 lakhs, that segment remains strong as of today. But anything beyond 20-25 lakhs, that segment has already starting to see their numbers go down, right? uh, Auto ancillaries were doing well because we were exporting to other nations, not just India demand, but we were capturing external demand as well. So that is why auto ancillaries kept doing well. Globally, if you see, a lot of these brands, expensive brands, BMW, Mercedes, Jaguar, Land Rover, FY24 was the best year for them. FY25 again is starting to see the numbers go down. We believe again it was a cycle. So even in Tata Motors numbers, if you see yesterday that came out, uh, the group didn't do that well purely because of what was happening with Jaguar and Land Rover, right? And I think that is a phenomena globally. Even Tesla is starting to see his numbers go down. Of course, there was some political angle to that, but from a cycle point of view also, I think auto sales has 2024 being the best year. 2025, 2026, you will see numbers not doing that well. Of course, rural economy led two wheelers and cars priced less than 10 lakhs could still continue to do strong. Real estate again done very well. We have seen prices doubling in the last 4 5 years. DLF, Shobha, Loda, Rustamji, you name it, Macrotech, everybody has done well. Everybody has made good amount of money. They are coming with a lot of new capacity. Now, if you look at the segment that is doing well, it is only the luxury segment that is doing well. Otherwise, there is not much happening on the uh, what do you call the affordable housing segment, right? So that segment is very timid, nothing happening there. Even the middle class segment, which is the 2 CR, 3 CR segment, that is not doing that great. What is driving numbers, what DLF are these Trump towers and some really really large projects where you have individuals like what's this guy, the Zomato CEO. So he's buying a 50 crore property. A couple of individuals like that are buying, very expensive property. That's driving DLF upwards. But in the lower segment, people, middle class people, lower middle class people are not being able to afford houses right now. And at some point of time, that cream segment, that luxury segment will also dry out, right? And at that point of time, you will really start to see that space go down, and I think fairly fast, because we've already seen prices stabilizing. So if you look at the per square feet prices across the large 4 5 metros in the last 4 quarters, we've already sort of reached a point where these prices are not increasing anymore. It's only the volume that is playing. The value has sort of almost peaked out. So, and volume will continue to be a story because India as a country, we a lot of people who don't have houses. So houses will be sold, but the prices will stop going up. And that's precisely the story. But what will also happen is a new wave of supply that is coming in FY26, FY27. Those projects will get launched. And then that is when you will start to see a situation of higher supply and lower demand. Uh, and that is when the sector will start to underperform, in our opinion. We could be wrong, maybe a quarter or two, maybe. I've been talking about this sector going down for a quarter already, and I've been wrong for a quarter now, so I'll probably be wrong for another 2-3 quarters. But I think by the end of next year, we should start to see this materialize. What about wealth management sector? So wealth management sector, again, this is value migration theme. The broader theme is financialization of savings. So more and more people, and people like you and me, who are middle class individuals who traditionally not invested in equities in a big way, will start to invest in equities in a big way. We've already seen demat accounts go up. So this space, and a lot has played out in terms of valuation. I think the this sector might just be rightly valued. I don't think there's a lot of too much P rating here. I think EPS growth could take this sector upwards by 10-15%. I think we could see 10-15% CAGR in this sector purely on the back of EPS growth. I think valuation point of view, a lot of these sectors are priced appropriately. It's not undervalued for sure, because we've already seen, stocks like CDSL, NSE, BSE, NSE to listed nahi, but BSE, some of these bets already play out. So yeah, I think brokerage is also, uh, you know, Angel One, IIFL, JM Financial, Motilal Oswal, very good numbers, appropriately valued. But opportunity is so immense that there is, of course, a 10, 15, 20 year growth to be seen in this segment. Uh, this cycle, in my view, is almost done. We will now see some rationalization here. Valuations will go down, growth rate will go down. Uh, CDSL, we've already started seeing that the stock prices is now in downtrend. So, I mean, from a long-term point of view, very good sector to be in. Anything else? We're already sort of close to 12. Any other questions? Cool. Thanks a lot. I think so. What we will now be more consistent. We'll now be more consistent with this. We are trying to do this at least once a month. These are YouTube sessions for our clients as well as the broader public. Of course, we will not, anything that we discuss here is not a buy sell recommendation. So take it with a pinch of salt. These are at the end of the day our opinions, and not a recommendation. So but we will try the best to decipher whatever is the market is trying to tell us, from a numbers point of view, from different sectors point of view, from a valuation point of view, and we'll try and do this more regularly. So please subscribe to our YouTube, and do check out our small cases if you think it adds value to your portfolio. That's a lot. That's a lot. Thanks a lot for joining this session, and have a nice weekend. Thank you.